What we do know from history is that while it's impossible to predict when these sort of events start and when they end, they all have one thing in common, and that is they end.
We've obviously had a lot of member questions come in.
Volatility is inevitable. It is part and parcel of any long-term investment journey.
Hi and welcome to this special edition of Super Insider. My name is Josh Van Gestel. I'm the Head of Education here at ART, and because of everything that's going on in markets and the questions that we're receiving from you all, we thought that we'd bring Mr. Brian Parker, our Chief Economist, back into the studio with us. Hi Brian, how are you?
G'day Josh, good to be with you.
You've been a very busy man of late.
Yes, very, very busy. Lots of questions for members and advisors and employers. So obviously what's going on in the world is causing a lot of concern, but hopefully we can clear up some things today.
Let's do that. But before we do, please be aware that everything that Brian and I are discussing today is of a general advice nature only. We encourage you to explore resources and get support and guidance where you need it to further think about a lot of what we're talking about today and how it applies to you personally. So Brian, when we're recording this, it is Monday, 16th of March. Can you just give us a bit of a sense as to where things are at the moment and what we've really seen happen with markets and the impact on super over the last few weeks in particular?
I think this is a really a lesson in the kind of world that we're in right now, is that we were already in a very uncertain and volatile world, a world that's ripe for disruption. And there's no point in sugarcoating what's going on here. This is a major conflict in the Middle East. No one knows how this is going to evolve. Our base case assumption is that at some point, both sides will look for some kind of an off-ramp and things will settle down. But when you talk to people who are seriously good at this stuff, who are seriously good at military strategy and geopolitical strategy, they never talk uncertainties. They never talk uncertain outcomes. They never say this will happen or that will happen, because frankly, military conflict is just an inherently uncertain proposition. One thing we do know from history, though, is that as bad as these kind of periods can be, they all have one thing in common, and that is they come to an end. And when we're thinking about the impact on superannuation, we had very, very strong investment returns during 2025. The year started reasonably well, at least for share markets. And obviously, given the events of the last few weeks, you've seen share markets fall off their highs. But I think we also need to provide a bit of context, that this is a relatively short period of time where you have seen quite a significant fall in equity markets. It's not historically unprecedented by any means in terms of the magnitude of the falls, but I think we need to put the last few weeks' volatility in a longer-term context. That the longer-term returns from superannuation have been very, very strong. That the markets have generally been very kind, not just over the last year, but over the last decade or longer, and that superannuation is the longest-term investment any of us are ever going to have. And I think we need to keep that in perspective when we go through periods like this, as tough as they are to watch.
And even you talk about the last 10 years and having really strong returns coming through that. That was in spite of the fact that during that period we saw another big downturn with COVID. There's a chart that you present quite often when we're doing member events that talks about if you invested $10,000 in one of our diversified options over 20 years ago. What do you talk to about that chart?
Yeah, what I do is I show the chart which shows, right, at the end of December 2002, I put $10,000 into a range of our diversified investment options, including the most aggressive, which is the high growth investment option, which has 85% of the portfolio invested in growth assets such as shares, down to the more conservative option, which has only 30% of the portfolio invested in growth assets such as shares. But I also have a line on the chart showing the CPI. In other words, if I wanted to invest and just keep up with inflation, what did I need to deliver? I needed to turn my 10 grand into about 18 or 19,000 from memory. And what it shows you is that over the very long term, the more risk you are prepared to accept, in other words, the more exposure to growth assets you have, the better the long-term return you get. However, there's a trade-off there. It means you are more exposed to market volatility. You're more exposed in the event of a major share market downturn. But the reward you get for that, if the reward you get for being prepared to accept that volatility, is a better long-term outcome. Now, when you wind down the risk, the trade-off you make is to say, well, look, I know I'm going to accept a somewhat lower long-term return, but at least I'll sleep better at night.
Yep.
And sleeping at night can never be overrated. The other thing I talk about on that chart is that if you go through that period, some 24 years or so, or nearly 24 years, what happened over that period? It was certainly not all smooth sailing. We had the second war in Iraq.
Yep.
We had the global financial crisis. We had the European financial crisis. We had a string of events in the Middle East, the Arab Spring, for example. We had COVID. There was a whole period there where a number of, quite negative, the war in Ukraine, the events in Gaza, all of these things did cause significant market volatility at the time. And many of the conversations we've been having with members in the last few days kind of resonate with me because they're the same kind of conversations we've had periodically over many years. Because whenever we do see markets take a significant downturn, a lot of members want to respond to that and say, well, maybe I need to become more conservative. And that's always a dangerous thing to do, to become more conservative after the fact, after markets have already weakened.
I find it interesting at times like this where we know members are almost going to be looking at their app and their balance on a daily basis and probably get very short term in their thinking and forget that it's not the last 3 weeks they should be concentrating on. It's actually what's happened over the last decade, 20, 30 years.
Absolutely. And again, everybody's different. Everybody's been investing for a different period of time. Everybody has different risk appetite and everyone has different financial goals. They're at a different phase of life. But over the last 10 to 20 years, the returns from superannuation, generally speaking, have probably been significantly higher than what might have been expected 10 to 20 years ago.
So thinking about that, what forecast do you really see
firstly,
leading forward?
We certainly don't try and we try and take advantage of market volatility, but we don't design portfolios based on our ability or anybody else's ability to try and forecast how the economy is going to play out in the short term, how investment returns are going to play out in the short term, and definitely not how various regional conflicts are going to play out in the short term, including the war in Iran. What we do, however, is build really well diversified portfolios using a broad range of assets that are designed to be robust, that are designed to ride through this sort of volatility. But also, in order to actually design these portfolios, we don't try and forecast short-term market returns, but what we do, however, is try and come up with assessments of what sort of investment returns are achievable and sustainable over the next 10 to 20 years for the range of asset classes we invest in, from cash and bonds through equities and into the private assets, including private equity, infrastructure and real estate. That's where we focus more of our effort. And to do that, we spend a lot more time thinking about how the world will evolve over the longer term, not just in an economic sense, but also geopolitically.
So, although Iran isn't something that can be predicted and what's going on at the moment, you certainly have an expectation that in any forward thinking that there is going to be events that we can't foresee, but we almost account for the fact that they're going to happen in some way.
I think if there's one takeout from this, is that volatility is inevitable. The cause is going to vary every time, but volatility is inevitable. It is part and parcel of any long-term investment journey. But what we do know from history is that while it's impossible to predict when these sort of events start and when they end, they all have one thing in common, and that is they end. As you've heard me say time and time again, way too often I suspect, is that there is always a light at the end of the tunnel, and it's not a train, it's the end of the tunnel.
That's right.
And I still think that that's the case, and I still think that applies to the situation we're facing today. It's our job to think longer term about these things, and that's exactly what we do.
And there's a story that we tell where we reflect back on, well, what happened if you moved to cash during COVID? And if you look at it from a 1-year perspective, that a person who moved to cash as the market fell may end that year actually feeling pretty good about where they're at. And we talk about this for someone who's commenced a retirement income account and is drawing down. So they move to cash, they see share markets still going down, they probably feel a bit better about how things are or the action they took. But what we know is typically when a person moves to cash, they then don't know when to move back in. And so we tend to see that conservative investment profile continue. And over a 5-year term, if we use COVID as an example, if they stayed the course, they would have reaped that benefit from that high growth period that you talk about.
COVID as a financial event barely lasted a month.
Yeah.
Because markets turned around remarkably quickly.
And that's what I was going to say, that you saw a really quick reaction then. But if we go back to global financial crisis, in the decade afterwards, it was this wonderful period of growth, wasn't it?
Yeah, absolutely. And you raise an important point. If you decide to try and time these things, if you decide, no, I'm going to go to cash and I'll sleep better at night, you might feel good for a while, which means you might think, great, I got one decision right. But you need to get two decisions right. Because if you are going to build wealth for retirement, you do need at some point to get back in. And certainly our experience is, and I've been doing this for 35 years, timing when to get back in is every bit as much of a challenge. And long experience suggests that as long as you're invested in such a way that you can sleep at night, you've got a well-diversified strategy of reasonably good quality investments, and you're comfortable with the time horizon you're investing over, trying to time these things is a waste of time. You end up more often than not destroying wealth. You're better off, in most cases, you're better off sticking to the course.
But it's important with that in mind that that's how we manage our default options. That
we
is
reduce
done
risk,
very
absolutely,
much.
yeah. And that's the thing. For a large number of our members are in the defaults, and it's probably useful to remind our members as to how that's invested. So up until the age of 50, our default members are in the high growth option. Age 50 through to 65, we start to very gradually reduce your risk at the individual level. In monthly steps. So you'll transition from that 85% in growth assets. By the time you're age 65, you'll have 20% in cash and you'll have 80% in our balanced option. It still means you'll have exposure to shares, but your portfolio will be more conservatively positioned.
And it's very much thinking about times like now, as well as the growth opportunities that we'd expect would follow, isn't it?
Absolutely. Don't let the last 3 weeks dictate your next 3 decades.
And I'd think even to that point, it's don't let the last 3 weeks be the only thing that you think about the last 3 decades. There's
absolutely,
been great growth.
Very much
what
so.
I want to do, Brian, we've obviously had a lot of member questions come in. So can I just ask you a couple of things that we have had coming through is, should I be thinking about investing in gold or other commodities? What's your view there?
I think the short answer is I would be very, very careful about investing money in something after a whole bunch of other people have already made money out of it. Go back to the line before about past performance not being a good guide to future performance. That certainly gold has done very, very well. I think the gold price has risen to levels that few, if anybody, would have expected. And so there's always a bit of fear of missing out. There's always a bit of regret. Oh, well, why didn't I do that 10 years ago? Maybe I should do it now after a bunch of other people have made the money. That always rings alarm bells for me. Certainly in our diversified portfolios, we have fairly limited commodity exposure. It's kind of direct exposure is tiny. What we do have exposure to is certainly mining companies, including gold mining companies, that pay dividends and grow their earnings over time and benefit from higher gold and other commodity prices. For us, we think that's a more reliable way to play it. Because frankly, the price of gold is quite volatile over time. Commodity prices can be very volatile over time, and trying to predict those sort of movements in commodity prices is a challenge. So be careful of just letting the regret of not being there influence your future decisions, is what I'd say.
Thank you. What is ART doing, and you have talked a little to this, but what is ART doing to manage the current risks associated with geopolitics?
Probably 2 things that stand out. One is take advantage of volatility. So this sort of volatile environment does provide opportunity, and we are taking that opportunity. But the second key way that we help manage risk is through broad diversification, a range of different asset classes, a range of different industries, investment managers, countries, regions, etc., but also having a significant exposure to private assets in our diversified portfolios. And these private assets, infrastructure, real estate, private equity, private credit, when public markets or listed markets such as shares are running hot, those assets tend to lag a little bit. They don't tend to do quite as well. But the flip side of that is that when markets are performing poorly, they tend to hold their value to a much greater extent, and that's exactly what they're doing. Now, obviously, if there's a more prolonged economic impact, then certainly those assets are going to be affected. But those assets over time do help to smooth the ride for our members, including in these really challenging periods.
Probably the part of our audience that's quite concerned at the moment are those who are in retirement phase or thinking about it. We've had a lot of questions from people, particularly who are about to enter into retirement and thinking about whether they should defer that or delay that. Do you have any views or thoughts on what they should be thinking about?
I would say that it's such a deeply personal decision to make, and one that, in my view, shouldn't be made without advice. But let me share a couple of thoughts. One is to reiterate something I said before. Don't let the last 3 weeks determine your next 3 decades.
Yep.
But also remember, put the last 3 weeks in a longer term context.
Yep.
Think, well, how much money do I have now? How much money did I think I would have by now? When you look at the way markets have performed over the last 10 to 20 years, the returns have probably been better than most observers would have projected 10 to 20 years ago. And so in a way, if I think about, again, simplistically, but if I think about my long-term savings trend, I'm probably still above that longer-term trend.
Yep.
I probably still have a balance that's higher than what I mentally might have projected 10 to 20 years ago. I maybe have come back closer to that trend in the last 3 weeks, but I don't think I would have returned all the way there. I'm still probably better off at this stage of my life than I thought I would be all those years ago. Yep. So I think those are the two observations I'd make.
And I think we've had a lot of members asking about, should I reduce my income payments, asking, can I in fact stop them or freeze them? I think it's that same context.
It is very much, yes.
Those payments are basically, think of them as being determined off all that earnings that you've had over the last decade or more that you otherwise may not have expected you'd get. It's not you're not getting drawdowns from the last 3 weeks. You're getting those drawdowns or income payments from many years
I think so.
of work.
And provided you're invested reasonably sensibly, and again, the answer to this is going to differ for everybody. If you have a portfolio which is appropriate for your phase of life, then drawing down on a pension, even during challenging market conditions, still means that your money is likely to last quite a long time. I think the other thing to remember too, and it may or may not be relevant to the question you asked, but one of the things we also hear from members is this idea that I build up this money and I want to maintain it.
Yep.
Right. And partly it's a desire to pass on something to descendants to provide an inheritance, etc. But I think it's important to bear in mind that this is your money for retirement. In the vernacular, we call it the accumulation phase and the drawdown phase. It is there to be spent. It's there to be consumed in your retirement, so that you can have a better time in retirement than you otherwise would have had. So, just because the balance might be going down, don't necessarily see that as a sign of a catastrophe. It's not, because in many ways your balance is meant to be run down over the course of your retirement.
2 last questions, if I could, Brian. What's your view, and I know that things are moving very rapidly, but your view on what's happening with fuel prices and what direct impact that you think will have on our investment returns for members? I
think in terms of the increase in fuel prices, so far it's been relatively short-lived, but again, no one knows how long this is exactly going to last. Now, let me paint the very adverse scenario first, okay? If we were to see a further increase and a sustained level of higher fuel prices, that is likely to provide act as a significant tax on consumers' spending power. And you are likely to see an impact on consumer spending and on the economy. Whether the impact is severe enough to cause a recession, either here in Australia or in the US or elsewhere, is still very much an open question. A lot of that does depend on how long that lasts and how policymakers respond to that. You'll also see another resurgence in inflation, at least for a time. But again, how long that lasts depends on how long the oil price surge lasts. But make no mistake, I do think that at some point, all sides of this conflict and the people talking to people on either side of the conflict are going to encourage the participants to look for an exit ramp. That someone is going to want to look for an exit ramp, because no one wants to bear the economic cost of this. Not just the humanitarian cost, but the cost of this in terms of blood and treasure is potentially horrific, if not already horrific. At some point, an exit ramp is going to be sought.
Yep.
The sooner, and frankly, the sooner the better, both from a humanitarian standpoint, but also from an economic standpoint. The reason I highlight that very adverse scenario is if there is a recession, that is likely to impact on corporate profits and hence on share markets. Now, what would we do in response to that? We would probably seek to take advantage of that, frankly, because it's when you get those sort of significant market declines, if you have the dry powder at your disposal, if you have the ability to not just ride that out, but take advantage of it, that can add meaningfully to future investment returns. Being able to actually position portfolios to benefit from that eventual upside as the economy eventually and inevitably recovers.
Which again goes to an earlier point that if you move to cash now or dramatically move to a conservative option, there is that future potential with the dry powder
that you do miss out on. Exactly.
You miss out on.
I think so. And while, as I say, sleeping at night can never be overrated. Before making any significant shift in your portfolio, particularly to move more conservatively after markets have fallen, understand the trade-offs. Understand that you won't benefit as much when markets recover, and that the longer-term investments returns you're going to achieve are not going to be as high as they otherwise would be. Now, again, if you're okay with that and you sleep better at night, that's absolutely fine. But there are trade-offs here.
So to just wrap up, Brian, for members who are still uneasy, we're obviously going to be talking a lot more in the weeks and months to come, especially depending how things go. We are doing member events. We have quite a number coming up over coming weeks that members can come to. But what else can they be thinking about or doing? Probably, I would say, from my perspective, not looking at their mobile phone as often.
Someone said to me some years ago that often the best long-term investment strategy you can adopt is benign neglect. That sometimes looking at it every minute of the day can just be exhausting, quite frankly, and can lead you to make really poor investment decisions. I'd say a few things. One is, if you do have a financial advisor, now's the time they earn their keep. Pick up the phone and have a chat to your financial advisor. Also, get onto our website. There's going to be a whole bunch of material. There already is material there. In particular, I draw members' attention to the calculators we have on the website to actually put in some numbers and play around with it and say, well, look, how much have I got now? How much do I think I'll need? What do my projections look like? I think that's a really, really useful tool.
It is also times like this where it maybe stops and makes you think, well, what sort of investor am I? Has my investment profile or type changed? And we have a great investor profile tool that just allows people to maybe have an arm's length review of how they should be thinking about their investments. Thank you, Brian. I think having you here today has provided a lot of reassurance for our listeners.
I hope so. Thanks very much for the opportunity, George.
And we'll be back with you with our normal podcast series, with our next one focusing on Gen X, which is both Brian and I thinking about our future retirement as well as managing our finances today. Until then, thank you very much.